Welcome everyone. Thank you for joining this webinar. A big thank you to the Hong Kong Jockey Club Charities Trust for hosting the event. The HKJCCT convenes a Philanthropy for Better Cities Forum in Hong Kong every year. It is the largest philanthropic conference in Asia and a great meeting place for philanthropies from all corners of the world. And to continue the conversation amidst the pandemic, like many of us, we've been convening a series of online conversation for leaders in philanthropy. We conducted the first of these in April 2020, right as the pandemic hit, focused on strengthening the flexibility of philanthropies in their sort of urgent on-ground responses to COVID. This was followed by a second webinar in December 2020 that focused on the role of philanthropies could play in shaping the post-COVID-19 equilibrium. And this today is the third online edition of the forum. Now, we know that in the past 2 years alone, the world has witnessed significant reversal in its progress towards the UN Sustainable Development Goals. And at the same time, an even greater challenge looms in terms of climate change. So with that in mind, we've organized today's dialogue to deliberate on the role of deep science, deep tech innovations can play in accelerating progress on sustainability and climate change. Deep tech is of course unique and different from general tech. It takes a first principles approach combined with fundamental research and a visionary ambition. These are normally technology-based solutions based on substantial scientific or engineering challenges. And they present challenges that require lengthy research and development and large capital investment before successful commercialization. So a very different ecosystem, a very different level of engagement is required to bring this to life, and we'll discuss some of that today. But obviously a great example, the COVID-19 vaccine, which was developed in 9 months with a novel mRNA approach. Only this week, Time Magazine has called the developers the heroes of 2021. Is truly an application of deep science to improve societal outcomes. And that's what we're going to look at today is how can we generate more of such societal outcomes by making the right level of investment in deep tech. Whether you're looking at carbon negative concrete, invisible food protection layers to double shelf life, the potential for plant proteins, degradable plastics, solar farms and oceans, these are all things that are based around some new deep science that is coming out. And many of our speakers today will talk about the opportunity in the sustainable development space for these kind of innovation. And it begs the question, what else is out there, particularly in sustainability, that has the potential for outsized impact, and how do we invest, make the right level of investment? We are really excited to kickstart this discussion, and I'm going to pass the ball to my friend Erin Barringer. Erin is a senior partner at Dalberg, where she leads our America region and also leads Dalberg's global health practice. Erin, over to you for panel one.
Thank you, Gaurav, and thanks to all of you who have joined us today. I'm really excited about this first panel that we have for you, and we have an amazing and diverse set of speakers who have joined us. We will spend about the first 40 minutes on discussion, and then we will open it up at the end for 10 minutes of Q&A from you all in the audience. And our plan for today is to discuss the exciting opportunities that this group is seeing in deep science and deep tech, and the role that it can play in helping us to progress in the areas of sustainability and climate change. So without further ado, I want to dive in, and I'll start by introducing our panel briefly. We have with us Helen Lin, who's a principal of Azola Ventures, Olympia Jager, who's the CEO of GoTerra, and Matthew Norden, who's a general partner of Azola Ventures. And so we're going to dive right into questions. And I'll start with you, Helen, who is joining us live from the UK. And I know that @ONE is aiming right now to raise a new $300 million round for its second fund with a significant focus on climate tech. And so I'm curious to hear from you why you're so excited about deep tech. What makes you think that it can really be transformative? And if there are specific trends that you're seeing that you're especially excited about, would love for you to kick us off and share them with the group.
Great. Thanks, Erin and Gaurav and everybody else for hosting. So the cornerstone of our investment thesis and strategy into deep tech and as a tool to fight climate change is we see deep tech's potential to create what we call disruptive unit economics, which is a very fancy sounding way of saying that we have an opportunity to rewrite and recreate the way a lot of industries go about doing things. And to do them in brand new ways that are not only better for the planet, but actually can cost less than the traditional ways of doing things, and therefore become this no-brainer value proposition for customers to adopt at scale. And so that's kind of the beating heart of our investment thesis and why we focus on deep tech. And in terms of areas that we find interesting, we are industry agnostic, so we invest across all industries as long as there's a big environmental problem to solve and a technology that can viably crack that problem. In the past year, we've seen a lot of activity in food tech and ag tech, areas like cellular agriculture, areas like drone technologies, et cetera, which we can dive more into later. But yeah, I think across all fields, there's a groundswell where everyone is realizing that, if they don't change now, that they will be the ones that will be disrupted later on down the line. So we're actually seeing a lot of activity across all industry verticals.
Excellent. Thanks, Helen. I want to come to you next, Olympia. You are a deep tech entrepreneur yourself, and GoTerra has become this cutting edge infrastructure technology company leading the industry in creating waste management ecosystems and solutions. And so I'm just curious, from where you sit, how you started GoTerra and what some of the key conditions were that you needed to establish this company, and that you think other kind of deep tech entrepreneurs would benefit from to really accelerate in the space and accelerate their impact.
Yeah, sure. Thanks, Erin. So I came from conventional agriculture. I was sheep and cattle professional originally, and I moved to the US for a period of time. When I came back to Australia, wanted to go back to agriculture and realized the landscape had changed, and the profitability of agriculture had really changed significantly since I'd been away, and not just in Australia, but I'd been out of agriculture altogether. And so I was looking initially at creating protein to stabilize the volatility of market forces, which is why most people start insect production. But the longer I looked at trying to feed an insect colony to create sustainable protein, the more I realized that whilst that substrate exists in large volumes, it's not in one place. And the real challenge of food waste is about its volatility, its lumpiness, and the logistics and infrastructure challenges surrounding the managing of it. And so we designed, instead of a system where you bring food waste to a centralized plant, the technology so that you could take waste management to the site. And instead of disrupting everything, you integrate the system into the existing waste management capability of an organization or a location or a region, and create circular economy with that infrastructure. So in a very short and less glamorous way, we've created robotic systems that get insects to do a job. And the flagship job that our system does right now is manage food waste with insects. And that process creates a protein and a frass, which is a manure fertilizer. It all sounds really cool and exciting. And I think the challenge when you talk particularly about technology that's hardware, technology that's big, your infrastructure funding and technology funding for hardware is difficult. Everyone will talk ad nauseum about how hardware is hard. If one more person says that to me out loud, I'm going to put it on a t-shirt. But I think more importantly, what's difficult is it's not as hard, any more hard than, any deep tech with SaaS or any of those sorts of things. What's difficult is the known unknowns for hardware hurt more and cost more. And so the amount of funding you need to put into a hardware business generally in the early stages is significantly higher, and the unknowns are larger. So putting a bunch of insect larvae inside a box is really difficult and takes a long time. And so that was most of the key challenges for us were around investment capital that could see the vision and had the courage to invest at a stage where it was, minimally viable, and could understand how to value the company when most investment theses follow a very SaaS platform valuation methodology. And so those were the things that were most challenging. And certainly when I talk to other investment people who are interested in investing in deep tech, particularly hardware, I talk to a lot of founders about it, and I'm like, find ways to explain your business model so that it can be translated into unit economics that makes sense. Because generally it just looks like I'm going to have to pour a lot of money into this organization and it'll be 10 years before revenue is realized. And that's a much more difficult conversation to have than we are like this, and this is how we make money, and this is our, these are the evolutions and milestones that we're going to go through to make that true. So, yeah.
Super interesting. Thanks, Olympia. And I want to shift actually to Matthew, because I wonder if you have thoughts on this notion of the longer investment cycle, a longer R&D cycle. So Matthew, you've been an investor and advisor in cutting edge technologies for over 2 decades, and curious how you understand and how you think we should all understand the potential impact of these deep tech investments before they get to commercial application, and how you think about that kind of longer term risk and strategies to defray that risk.
Yeah, this topic is near and dear to my heart because it's why we exist. So I'm a general partner at Azola Ventures, and on one hand, you could describe us as a very early stage venture capital firm focused on climate. But our model is really, really different. We actually were founded as a program of a 501c3 public charity called Prime Coalition that I was fortunate to help co-found in 2014, whose mission was to start with a blank sheet of paper and try to figure out if there's a universe of technologies formed by startup companies that can bring social good into the world in a variety of cause areas. Although our focus is climate, you could apply the model that we've developed over time to human health or to safety of women and children in challenging places in the world. Our focus has been climate. And the insight of my partner, Sarah Carney, the executive director of the Prime Coalition 501c3, was that there is actually more capital sitting in US family foundations, the country that I'm based in, than the entire venture capital asset class several times over, let alone the other 200 odd countries in the world and corporate foundations and institutional foundations and donor advised funds. And if we could shave off just basis points of that capital, whose opportunity cost is generally grants, and therefore is structurally more patient and risk tolerant than mainstream investment dollars might be, you could do a lot of good. You could fill some very significant capital gaps. And I saw this up front because I learned venture capital investing at a firm called Venrock that is arguably the oldest VC firm, originally the venture arm of the Rockefeller family in the 1930s. And I went there in the late 2000s, running a little revolution versus reform experiment to see in the mainstream venture system, could you fund true breakthroughs for climate? The kind of innovations that people hear about and think, wow, that's awesome. And someone should invest in that. Just not me, just not now. I'd like to look at it later, once things are de-risked. And it was a tough experience. On one hand, I was able to support companies that did very well, like a smart thermostat company, Nest, that was acquired by Google, or Lucid Motors, an EV company that's achieved a pretty extraordinary market cap in recent months. But I kept coming to the Monday morning meeting and throwing up bricks, bringing companies that were really interesting. And the attitude of my colleagues was, we love these people and we love what they're doing, but maybe they could come back in 2 or 3 years once it's more worked out. At Prime Coalition, as I mentioned, we incubated a new model to address that. We invested first through syndication without a fund, then did our first fund, Prime Impact Fund, in 2018 that's recently wrapped up. And now our newest fund is Azola Ventures. And we can talk more later about how we view the world. I tell you, the reason that I'm excited And I think now is the time, for creative and catalytic capital to drive these solutions on deep science and technology in our space, climate, and in others, is that I think an enormous amount has changed. There was a flirtation that Silicon Valley did with investing in what we would now call climate tech in the 2000s that went terribly, where many billions of dollars of capital was destroyed and went to zero. And it was an environment where everything was different than now. The investors were not steeped in deep science and climate from birth. There were folks who were kind of trying to translate uneasily from mainstream tech investing or biotech to fields that were just totally different in terms of capital requirements and timeframes and valuation multiples. You didn't have a well-developed financing ecosystem to pick up these companies once they had initially been funded. And you didn't have supportive offtake agreements, people who were willing to buy what was being sold. I think all of that is different now. You have this universe of investors that have been born in deep science, people like Helen, for example, whose team we've collaborated with and can only say great things about. We have a very supportive infrastructure of finance going from pre-seed through to project finance that scales, an unprecedented amount of money in the category. But then third, there have now been experiences from the past that give us a playbook. We're in a different environment where software tools allow us to de-risk hardware innovations in silicon versus having to do all the experiments at the bench. We depended on governments, to price carbon and create offtake agreements for these kind of things. Instead, we have corporations stepping in where governments won't because of their ESG requirements that allow them to keep being traded through passive indices. I just think all the arrows are aligning in the right direction. And it creates an opportunity for folks like those in the discussion today to really make a difference and lever capital beyond what it could have done a decade or two ago.
Thanks, Matthew. A super helpful kind of historical look too at the space and how it's evolved. I wanna move us on to talk a little bit about how we best support these deep science, deep tech kind of entrepreneurs. But first, actually, I'm curious, you all have talked a little bit about what excites you in general about the space, but I'd be curious just to make it specific for this audience, right? This can be a kind of nebulous, squishy, wide sector. So I'm curious if there are one or two specific components of deep science, deep tech that you're particularly excited about today. And they can be specific technologies, they can be areas of the sector, but curious what you all are seeing that you think really can lead to step changes in sustainability and climate change. And I'll let you all pick the order unless no one goes, in which case I'll happily cold call. But what specifics are exciting you all today? Olympia looks like
I'll go. So I'm really excited about automation, and I think what I see is that we have to radically change the way we do business so that we can move to a circular economy. Like right now, we are trying to stuff a circular economy into our linear way of life, and our supply chains are kind of like, it doesn't work, and those things are difficult. And so automation, I think, across any industry is starting to help that transition, and things that can deliver autonomy to service provision and things like that are sort of paving the way for those changes and flexes in how we do our day-to-day, so that we can move and adopt to the new way of doing things. So I think, most of the automation that I'm seeing, specifically there's, Swarm Farm in Australia, autonomous farming equipment, Wholebot, autonomous boat cleaning, like those things I think are just, radically going to start changing how we look at, doing life normally, and also creating massive step changes in improvement of our way of life and mitigating climate change for sure.
I can jump in there with a few categories because our whole thing is that we try to only invest catalytically. We do the opposite of chase hot deals, quote unquote. We actually chase neglected opportunities and try to find cases where there's a real opportunity to make a difference in climate, but where mainstream investors may not be there yet. And I think there are probably three things we end up looking for. One of them is categories that may receive a lot of investment interest, but that have hidden corners that are enabling. In 2018, when we started our last fund, I think it was the highest year for investment in mobility, sort of transportation technology on record. And because of our mandate, we never would have invested in an autonomous vehicle or an electric vehicle charging company. But there were key enablers for the future of transportation, like extraction of the lithium that will be required for 30 times more lithium-ion batteries in 10 years, or development of motor generators that are the opposite of what we have today, that are more efficient the slower they go when you're accelerating from stop in an urban mobility environment. Versus they get their best efficiency when they're going at a very high rate of speed on a highway. We made investments in both of those categories in companies called Lilac Solutions and C-Motive Technologies. So Hidden Corners is one. Another is frontier areas in decarbonization that are going to be the hardest to decarbonize areas of the economy. Those often can be boring, but they're a very impactful kind of boring. So for example, right now we are very interested in glass making. We're very interested in iron and steel. We're very interested in industrial process heat, the steam that's needed in almost every process manufacturing facility to make stuff, and that you currently get by burning propane or natural gas, and where there's no real clean alternative. So we look pretty deeply at those areas and try to write investment theses in them that give us a roadmap to where we can find innovation. The last one is categories where the mainstream investment world may think all the innovation is done, and it's probably not. And I'd give a couple examples there. One of them is solar, where we really do have an infrastructure for solar power in the world that's built on a single technology, on silicon photovoltaics. But there are, in fact, other ways, that can be lower cost or more efficient in the limit to convert sunlight into power that really have kind of been left for dead by the mainstream investment world, but could be a big difference in climate. So we're doing a thesis there right now. Another is computing, where there is a roadmap that goes back to Google's revolution in using lots of little servers rather than one big server to get stuff done. That roadmap probably works through 2030. But there was a Semicon West, kind of the big conference in this category, series of presentations that happened just last week, where the consensus that was laid out by the data center leaders of the Facebooks, Apples, and Googles of the world is that there is no solution for the heat dissipated by computing operations in data centers past about 2030. And that forms a fundamental physical limit to how we can keep growing computing infrastructure in the cloud. It's not an area that I think most venture investors are looking at right now. It's one that we are because it's so in line with our climate mission.
Thanks, Matthew.
So Matthew and I in general are very aligned in life, in investing and otherwise. So I will probably say a lot of things that sound somewhat similar, although I'll have a slightly different spin on them maybe. So we like to start with frameworks, which I think maybe a lot of people on the line today might appreciate. And so if you just think about envision the pie chart of what are the biggest drivers of, greenhouse gases today. Over a quarter come from food and agriculture. Food and agriculture is often overlooked by a lot of other climate tech funds because they are focused on, things that have a tailpipe and, physical emissions that literally spew gases into the air, right? And yes, I'm not saying that's not important, but food and agriculture over a quarter, still very important. So we look at a lot of that. And you think about, agriculture takes up over half of the habitable land on the planet, uses up over 70% of the fresh water on the planet, is responsible for over 90% of eutrophication. I mean, the stats go on and on. I could go on about them all day. And so, and people talk about, oh, don't go vegetarian because if you eat soy, you're going to deforest the Amazon. Okay, well, dig another level deeper. You'll see that most of the deforested Amazon soy is actually going towards feeding pigs and cows that you then eat as pork and beef, right? And so we do a lot of alternative protein investments. I mentioned earlier, cellular agriculture is an area of focus for us, which, for those who aren't familiar, you take a cell of meat or fish and you put it in a bioreactor and you grow it until it becomes a chunk of meat or fish. So it's real meat. It's not a soy-based alternative, but you never had to rear a cow or a fish, with all the resources and pollution and everything involved to be able to eat that piece of real cow or fish. There are obviously going to be regulatory hurdles and consumer acceptance, kind of journey that we'll need to travel before something like that can commercialize at scale. But we are seeing something like that being sold commercially already in Singapore, where there's a company called Just, and they've already started selling the first cellular agriculture cultivated chicken nuggets to the general public. And you could go to Singapore and eat one of those today. So food and ag and alternative proteins, technologies like that, we're very excited about. I think I would also touch upon materials and material science. And so, the framework there being that everything in the world, and we didn't come up with this, we borrowed this framework from someone else, transparently, is that everything in the world that's a material is either comes from a mined source or a grown source. So even something like plastic, which is based from petroleum products, was originally mined. Right? And then stuff like paper and all of that obviously coming from trees. And so at a very high level, what we need to do is to move more of materials in the world away from these mined raw materials and more towards grown materials, and then find a way for the way the grown materials are grown to be done more sustainably through sustainable and regenerative agriculture. And so, for example, we've invested also in a company called Cruise Foam. They use shrimp shells to create a substitute for styrofoam or polyester, or sorry, not polyester, polystyrene. And so, it's definitely marine degradable. And it's also biodegradable in landfill and addresses a whole host of interesting packaging applications, even in their first stage of development. And we also have a green cement company that's developing a geopolymer that is not quite carbon negative yet, but is 85% carbon reduction from traditional cement, cement being 8% of global greenhouse gas emissions right there in one fell swoop. So yeah, I think material science also another very interesting space for us that we're looking at right now.
Thank you, Helen. And mostly, I hope if any of our audience members are in Singapore, you go try the chicken nuggets. I would be curious how they are. I want to shift us. We've touched on this a bit, but it strikes me that you all have shared some of the challenges that innovators in the deep science, deep tech space are facing today, especially this notion of longer term kind of investment requirements, hardware versus software. You brought up Olympia. I'm curious what types of support you think are most useful to provide to these innovators today, and how kind of we as a sector can crowd in and support them. And so maybe, Olympia, I'll start with you and ask you, as you were building GoTerra, what were the roles of different kind of types of support? I think especially outside of private capital, was philanthropy involved as you were growing, government support, et cetera? And how do you think about what that suite of support services are that can best allow an innovator to succeed in this space?
Sure. So the first thing, the catalyst for us to get kicked off was a non-match funding requirement innovation grant. And it was a small grant. It was only 30,000, but it was, not having to match that grant funding was actually like really beneficial. Like the challenge as a startup founder is that by and large, you have to somewhat be wealthy yourself to afford to be able to even try to try your new idea. And then, then of course there's the whole idea of family and friends. So you need to have wealthy family and friends to get you to support. And so having to match grant funding, which is a common grant requirement in Australia, it makes those initial sort of kickoff attempts really difficult. So having a grant that didn't require that, it was just upfront cash so that you could make a really meaningful step to creating something that could get an investor interested and move to that next phase was critical for me. The second piece of support was around sort of the advisor network that you have access to and can tap into. And largely, I think the burden of that engagement is on the founder, but certainly from my experience with my investors, having investors that were committed to being able to introduce founders to people that can help them. So, hey, I'm not sure what how I can help with that problem, but here is some XYZ from our network. And so being actively interactive with your founders and being committed to getting them the resources that they need to ask and deep dive on questions and things like that was really important. The last part for me was collaboration across the academic and research community. And so I am a bit of an oddity, not only just by being a woman in climate tech, of which I found out the other day, only 9.2% of climate tech founders are women. So yay. Is that I'm not an engineer and I'm also not a scientist. And so having access to academia and research organizations to get into the weeds on some of that stuff was really critical. And I think more importantly, not narrowing the aperture to one academic organization or research organization was also really important. One of the things that we believe we did well when we were sort of deliberating on this idea was we did not narrow the focus to one solution, one idea, one way of thinking. We kept that inquiry pretty wide, and we were getting sort of input from more than one source, and that helped us solve problems a lot faster and move through some of that DD and R&D much quicker. So I think it's about good networks, good engagement from the support networks that you have, and then keeping the aperture open on opportunities for collaboration, deliberation, and discovery.
Thank you. And even more impressive what you've built, as you said, with kind of a less traditional background in the space. So congratulations on that. Helen, maybe I'll come to you next with a similar question, which is, from where you sit, what are you seeing as the most critical types of support to give these deep science, deep tech innovators in order to really shift their alignment and correct market failures?
So it's interesting you raised the typical and atypical profile there, Olympia. I think we, probably align with those statistics despite our efforts of trying to support more underrepresented founders. But to your point, there's only so many of them out there for us to support. At the same time, the flip side of that is it means we've got a bunch of engineers and academics, like people who've been professors at universities teaching in a scientific field as founders in our portfolio. And they're brilliant. I mean, they're geniuses, but most of them have never built a business. Right. And so I think we come in a lot to help them with that. And we do a lot of hardware investing, which is maybe also a little bit atypical amongst VCs. So of our 22 investments, I think 18 of them or 19 of them possibly are hardware or have a physical product to sell. And so, whether you're making a robot or a drone, or a robot that 3D prints buildings, you still have the same manufacturing scale-up journey to travel, right? That any other kind of products company would. And so we come in a lot to help there ourselves directly. I think the connections you mentioned are certainly very key, as much as we like to think we're the most important people in, the company's lives. The fact of the matter is there's probably other people that are more helpful than we are that we just happen to know. And we do believe in ecosystem building. So even companies that we pass on so that we don't invest in, we actually still make loads of introductions for them to try and help them succeed, because it takes everything, right? We need as many of these startups as possible to go on and succeed, whether or not they're a fit for our investment thesis. So lots of connections to board members, recruitment agencies, manufacturing consultants, potential customers, strategic scale-up partners. I think those, when we do our survey at the end of the year, are the ones that the founders always say have been the most helpful to them.
Thanks, Helen. And maybe Matthew, over to you with a similar question, but I'm especially curious. You spoke earlier about your affiliation with Prime Coalition and kind of how powerful you've seen the potential for philanthropy in this space. And so would be curious to hear is that actually working? Are there still challenges ahead, and kind of what else you'd like to see, especially from philanthropy, but certainly other areas to support these deep science, deep tech innovators?
That is a great question, and great answers. So far, half of the companies that we've supported, the CEO's first job has been CEO, as in before that they were a grad student or a postdoc, and that means that all of that operational support that Helen describes comes with a big side dish of therapy. Because our whole mission, right, is about catalyzing investments that would not otherwise occur but for our participation, at least not for optimal climate impact. That mission is inherently philanthropic. And it's why, from the beginning, we crafted a model that was quite different. And from structure and governance through to underwriting criteria, through to incentives for the investment team, where half of the upside that is available to us from the performance of our investments is gated by our fidelity to impact mission, regardless of whether a company is financially successful or not. We've tried to do that from the beginning. What we've found is that if your goal, right, if the center of the bullseye for us is this principle of additionality, that we never want to deploy this scarce, patient, and risk-tolerant capital in a place where something would get funded anyway. We want to reserve it for cases where there are these needle in a haystack opportunities to catalyze something important but neglected. That's a moving target. And in the environment that we were born in, we made our first investment in 2015 through syndication from the 501c3 public charity. The tide was almost completely out in climate tech. There was a survey at the time that's now lost to the ages, the PricewaterhouseCoopers Money Tree survey that tracked venture investment across categories. It included what we would now call climate tech. They recorded that in Q2 and Q3 of 2016, first round financing of climate tech startups from institutional venture investors was $0 for 2 quarters running. And then that the next quarter, they just stopped tracking. They figured it wasn't worth it anymore. In that environment, we did not think a lot about whether a climate innovation was going to be funded by the mainstream or not. We focused more on, is it a big or small swing at bat in terms of emissions reduction, and what is its likelihood to be attractive to mainstream investors if de-risked on a small scale of capital. But the question of, is it going to get funded without us? We knew the answer to that. The answer to that was no. In this environment, things are very, very different. And I think that's had 2 impacts on the approach that we've taken as an extended team. One of them is that when it comes to making investments, we've remained true to that same principle of additionality. And it means that areas that we are excited about and focused on in our pipeline today are completely different than they would have been 5 years ago. It seems crazy to say, but we would not really contemplate making an investment in direct air capture of carbon dioxide out of the atmosphere because it's too hot a category. And again, those words in that order would have elicited laughter.
And it doesn't work.
Right. Well, we'll get to that one in a minute. It elicited laughter, from our peers 5 years ago. But now, if you're a smart young person out of Stanford or Wisconsin-Madison or MIT with a direct air capture proposition, you can probably get funded. The other is that we've thought really hard at the level of the public charity about given that the catalytic investing aspect of our mission probably well served now, what are all the other things we can do for entrepreneurs? And I would say there are 3 examples that I would raise that might be relevant. One of them that was raised by Olympia is that representation in founders in climate tech is pretty abysmal. That's certainly true for women. It's even more true for people of color. And on one hand, we have set targets in our investing activity for 1/3 of the portfolio being female or BIPOC founders, and also 1/3 of the portfolio being geographic diversity, which in the US we define as not the Boston area and not the San Francisco Bay. And we were a little bit below and a little bit above our 1/3 target in Fund 1. We aim to beat them both in Fund 2. We need to play an intentional role in that. So we started at the public charity level an entrepreneur in residence fellowship open only to BIPOC founders that enables them to embed within our team for 6 months, see what it's like on the other side of the table as a venture investor, and work with us to help grow and scale their companies regardless of whether we invest. And our first EIR, a gentleman named Erin from a startup called Mars Materials, is with us right now. A second is that a critical step for so many of these startups is being able to get offtake, being able to have a large corporation sign something on the spectrum of a letter of intent to a purchase order for the thing that they are selling. And that is a field development art. It involves large companies and industries together publishing their problems. So there's a clear view for venture investors as to what the target is that you don't have to be convinced of because the voice of industry is behind it, through to the art and tactics on the other side of negotiating something as simple as a materials transfer agreement. I'm going to send you a sample of my stuff. Here are the rules under which we have to treat it, where there are no standard documents. It's a dark art, and CEOs have no idea how to approach it. So one of the things that a charity that we are very grateful to is providing a grant to the 501c3 for is to create a position initially for a year to develop a sort of corporate industrial relationship program that would extend across the climate tech landscape, not just to our portfolio companies, ones that Prime has supported. We think that's a critical step in the ecosystem that isn't being hit. The third one is that what happens after these companies de-risk in the lab and they have to go out and build what's called a FOAK, first of a kind, FOAK, facility. Nobody wants to fund that. You generally can't fund them, through equity alone. It's way too expensive. You need debt. The debt won't show up without some portion of sponsor equity. And as a result, every entrepreneur has to pull a rabbit out of the hat, make some magic government grant appear, have some magic industrial partnership appear in a way that's not scalable. So as the kind of next frontier of a capital gap, we've worked in the last year with a very talented woman named Erin, who joined us from the Department of Energy in the US's Loan Program Office, to figure out what a catalytic intervention would look like in first-of-a-kind project financing as kind of the next frontier where catalytic capital can play a big role. All of those things are programs that are driven by the 501c3 public charity. They all are related to, but not part of our investment activity. And we think they're all really important in getting these entrepreneurs to scale and actually achieving climate impact.
Thank you, Matthew. Some really good anecdotes. And one of my takeaways is you have to be willing, it's a long haul game, and you have to be willing to get laughed at a bit in this sector. So kudos to the three of you for persevering through that.
Is that when you take slings and arrows, you smile and nod.
Yeah.
Smile and nod.
And you think you know better. We have 10 minutes left. I want to open it up for audience Q&A as well. So if you have questions and you're in the audience, please click on the Q&A button at the bottom of your screen and share your questions, and we'll pick up some of them. Given we only have 10 minutes, I'm going to ask for some rapid fire responses, and maybe to kick us off with a question that came in through some of the kind of pre-panel surveys. I'm curious what you all see, or if you see the potential for investors and philanthropies to partner and what that looks like.
So we have philanthropic entities investing with us. We have Soletto Cages, which are two philanthropic organizations have invested in us, and I think there's more than enough opportunity for that. Another organization that's invested in us is called Flying Fox Ventures, which is an aggregate where wholesale investors can aggregate and pool funds, so pseudo like a syndicate, and there's some philanthropic money in that as well. I think it is certainly an avenue where that can be true, and I have appreciated having that on my cap table because of the way they interact with me and the way that they have seen the business and imagine their role in participating in the business has been valuable. So for sure, on my side.
So, this is the verge point that we live at, where we're walking a tightrope with philanthropy on one side, investing on the other. The main thing I would get across is that to marshal philanthropic capital into for-profit companies, it's tricky. It's tricky both to abide by the letter of regulation that is different in one country to the next, but also to, more importantly, abide by the spirit of that regulation and not just have philanthropic money doing the same thing that commercial capital would and kind of acting as a dumb money or an easier source of fundraising, but instead doing things that are hard and pioneering. There's way too much to go into this. I think it involves starting with a blank sheet of paper and building an organization from scratch to satisfy those requirements in letter and in spirit. We have had many prospective fund managers approach us and say, hey, seems like you got a good thing going here, being able to take grant dollars and invest them. Can we add that as a feature to our fund? And we're like, it doesn't work that way. I sort of have to build it from the bottom up, from structure through incentives. And I think there's opportunity to do that today with some existing examples that didn't exist a few years back.
Yeah, so we're doing this rapid fire and it's such a huge topic, which is kind of inherently at odds. So I definitely agree with Matthew there. You know, there are things that philanthropic capital are really good at, and things where it's maybe not the best fit for purpose tool. And, you know, I don't know that this exists right now, but I, for one, would love to see some kind of hybrid asset class, which maybe Matthew can create for the world. Because, you know, in my previous life, I had worked in an organization that was very dependent on only philanthropic capital, and it always came with strings attached. You know, Olympia referred to kind of matching, that was one thing, but it was also just the burden of reporting meant we had to hire people just for the reporting alone. It was often for expense reimbursements for very specific line items only. So you had to still spend the upfront cash and then get reimbursed for it later. And then, you know, it could only be OpEx and not CapEx. It could only be for this and not for that. And so, yeah, there were definitely a few moments in history where we all kind of groaned inwardly and thought, oh, is this free money really that free? You know, at the same time, you know, it is free. So, you know, if there were some way you could get like the risk-taking upside of philanthropic capital, and maybe try to streamline some of these historical friction points, and if that can be done in, you know, in partnership with venture capital or otherwise, I think, you know, you'd be onto a really interesting asset class there that could be really fit for purpose for supporting startups.
Great, thank you. We have a lot of good questions coming in, and I realize I'm pushing you all on the rapid fire round, but maybe two themes that are emerging, and I'll let you all pick which ones you want to answer. So one is just around kind of what these opportunities, investments look like. Where are they based? Are you mostly seeing them in the US and in the developed world? Are you seeing them globally? And how you think about the duration of them? What do we mean by long term? So a bit of color on the investment opportunities you're seeing. The other I'm seeing some chatter around is the role of CSR. Is that playing into any of the work that you all are doing, either as an innovator or as an investor? So maybe we'll open it up if you all have thoughts on either of those themes.
Two quick thoughts. I think there are opportunities all over the globe. In our role as kind of early stage seed investors, it's hard enough to be a very hands-on, helpful board member 3 hours time zones away, you know, than 12. So I think those are interventions that are probably best done, you know, locally by people who are in market and can really be a partner to entrepreneurs. I do have strong feelings about the CSR point. You know, the do-gooderism of corporations, I think, is quite fickle. You know, it changes when the CEO changes, it changes when conditions change. I'm more excited about more enduring kind of structural ways that corporations are driven to decarbonize, which in my view is less about CSR and more about ESG. We note that in the US today, and it's similar in other places in the world, about half of all public equity investment funds are now passive investing, where companies are included and excluded according to rules. And to the extent that there are rules for exclusion that keep companies from accessing liquidity, that tends to make them do good things more, you know, than a statement otherwise. So I really think it's in the hands of the BlackRocks of the world more than it is in the hands of, you know, a sort of CSR representative in a big company.
I actually have really strong thoughts on both of these topics, so I will again make efforts to stay succinct here. On the global front, absolutely yes, the opportunities are everywhere, and climate change is a global problem, and so we need solutions all over the globe as well. there's also this concept of course, the people in the global south are contributing the least to climate change and yet are the first to suffer its consequences. And so from just a climate justice perspective, I think we have a responsibility to try and resolve some of that inequity. We recently invested in a company in Africa called Opibus, and they retrofit end-of-life fossil fuel vehicles, including buses and other commercial vehicles in Kenya, and convert them to electric. And so that is an interesting case study where, you know, we can pat ourselves on the back about electrification of transportation in developed markets, but then if those redundant gas vehicles then just get exported to Africa, which 40% of the world's end-of-life vehicles do, and they're driven as secondhand vehicles for another 10 years in Africa, then as a planet, how much good have we really done, right? And so I think theses like that, which whether you are a subscriber to supporting climate justice or not, it, you know, from an additionality perspective, it's just common sense, right? Like if we're going to push the agenda of electrification, we got to push it in a way that makes sense for the planet unit as a whole. So could go on about that a lot longer, but that's just kind of one illustration. And on the concept of CSR, and I think one of the questions posed was specifically about nature-based solutions. Yes, definitely nature-based solutions need to exist. And the challenge with them right now is there is no real easy way to fund them, at least not from a commercial way. A lot of those solutions are hard to monetize. You know, hey, go plant some trees. Okay, well, who's going to pay for that? Right? Hey, go protect a forest. Okay, well, who's going to pay for that? Right? And so, you know, this whole value chain of carbon credits and a market of carbon credits has been created to try and create a platform where you can funnel and channel some financing to nature-based solutions projects. Unfortunately, at the moment, that entire ecosystem is pretty broken. So, you know, if you are a person right now who is sitting at a large corporation trying to wonder how you could funnel some funding towards nature-based solutions, I would certainly encourage you to do so. But I think we're seeing a lot of movement right now in large corporations that are doing direct projects, which is obviously a lot of effort and investment for them as well. But because there is just like a very poor chain of custody, right, and poor transparency and trust in the true additionality and integrity of a lot of carbon credits today. And you hear even the Nature Conservancy has been doing some really questionable things with some of their projects in the past. And they are a conservancy agency, right? Then, you know, I think for now, that is the route we're seeing a lot of people take. And yes, of course, employing forms of deep tech to try and help bring down those costs and streamline that process for them. Yeah, I'll end there.
Thank you, Helen. Olympia, any thoughts on those two questions?
Like, I guess the one that resonated with me was about like, what does long-term mean? And I think how long's a piece of string is probably the only answer. I think thinking about deep tech, you know, and I can share my example is, you know, we raised 1.2 million Australian and then 8 million Australian and commercialized in 3 years. That's not the normal trajectory, but even still, that's considered slow. And then similarly, when we go to market now for our third funding round, the questions are generally around, well, if you're already commercial, then why aren't you more commercial? So lots of commentary around why there's not, you know, we'd love to talk to you, come back when you're 10 million ARR, you know. And so those challenges are sort of, they rub against each other. So you take time to get to commercial. You have to remember that deep tech companies are generally developing and delivering solutions that have no front or back end supply chain. So they have to own some more verticals than they normally would, because there is nobody that's doing, you know, they have to sort of own a lot more of that sort of down market supply chain particularly. And so the road to profitability tends to be a little bit different. I think that those are the challenges when we think about how long does it take. It's not always just about how long it will take for the innovation to be realized. It's also how long will it take for it to be commercialized or for that uptake to take place. And I think, you know, one of the things that we sort of try to figure out how to understand is what does our pathway to commercialization look like so that we can at least in some way fit into a model that makes us be able to progress through the next round of equity funding, or however we move forward from there. So it's just longer than SaaS, which tends to be a difficult metric to understand.
Yeah, many thanks. And we do need to keep moving to our next panel, but there's some additional great questions that came through in the chat. And so maybe I can ask these panelists, who we have so much to learn from, if you have strong thoughts, which all three of you seem to, and that's wonderful, on any of the questions in the chat that we didn't get to, please do answer them, because I'm sure the audience would love to see your answers. And mostly just want to say a huge thank you to the three of you for exciting us and inspiring us about the opportunities in this space, but also keeping it real and helping us understand the real challenges that you all as innovators and investors are seeing. I think it's clear that there's enormous enabling power from deep science and deep tech to improve sustainability. And you all highlighted some of the incredible opportunities that you're seeing, but also a real need to continue to support these innovators on a longer time horizon, more challenging market, et cetera. And some questions actually that you all posed, some challenges around, yes, there is a role of philanthropy, but making that work well is actually quite challenging, it sounds like, in this space, which is a nice segue to our next panel. So I will pass it back to you, Gaurav, to kick off the second panel. And a huge thanks again to the three of you for joining me today.
And I think it is, as Erin said, a great segue into our second panel, because in a way, the first panel has set the scene to say there's a lot of opportunity to be realized, right? We heard about some pretty exciting innovations that are going to, if they come to market, they're going to move the needle. And I think we also, I really enjoyed listening to Olympia's story about what it took to get to where she is at today. And I think one thing for us to reflect on in this panel is, even that sort of small, well-timed grant, right, at that initial 30,000 that she spoke about, is a great example of what can philanthropy do in terms of timing its interventions correctly in this overall process of bringing these kind of innovations to market. And so to think about what actually philanthropy can do, we've got a great set of panelists. Please welcome Leong Chung, Executive Director of the Jockey Club Charities Trust, Professor Fiona Murray, Associate Dean of Innovation at MIT, and Jian Yu Zhang, Executive President of BRI Green Development Institute. We've got a real array of opinions, and I think what we'll do is maybe, Leong, start with you, because the Charities Trust is a venerable organization. It's over 70 years of operation, and I want to contrast that with what we heard. Right, we heard that philanthropic capital, it can be patient, it can be flexible, and I think that's the philosophy, right? But philanthropic capital is then given out by organizations, and organizations over time can be conservative, they can have their own inflexibility and so forth. So as someone that runs such a large organization that looks at so many things, when you hear what you heard from the first panelists about, here's the opportunity, here's how philanthropy can help, do you think large philanthropies are well geared to support deep tech investments, and what would you change about them?
Right, so that's a very interesting question, Gaurav. Thank you. No, I think my own background is that I come from a private equity background. So when I think about sort of private equity versus venture capital, it's already very different. So how they select deals, the difference in risk appetite, how you look at sort of quarterly return for that matter. So coming back to your question, I think for very large philanthropic foundations, there is always whether you are a more like a public institution or like a community-based foundation or donor advised fund or family foundation, no matter how flexible you think your capital or how patient you think your capital can be, I think there is always a public expectations to your donation or to your grant making practices. So I think it's not just sort of internally how a foundation is structured, but then also, you usually, for example, the Hong Kong Jockey Club, we have been around in the community for, like you said, many, many years. You know, we actually started our first donation more than 100 years ago. So there is, before even there is a talking of deep tech, we have been doing a lot of different grant makings in the community, right? So the community has certain expectations of you to do certain things. So I think when it comes to new solutions, it would take some time. And I think it would be great if the bigger size foundations can really, again, like the financial world, use a strategic sort of asset allocation kind of mentality. So to me, I don't think you have to say yes to 100%, but you don't need to say no either. Right? What you can do is always, okay, I can still keep whatever it is, 90, 80% commitment to continue to work with the community for, you know, more immediate kind of, whether it's emergency relief, you know, or supporting the underprivileged for, you know, food or other things. But then in the meantime, can you allocate a small percentage of the asset to, you know, for the longer term, potentially longer term impact, but then potentially higher risk that's required.
Right, so you're advocating, so let's carve out something in our portfolio that can take that sort of risk. We come back to why you said it needs to be small, because it could be large, right? So we'll come back to that question. But let me turn to Professor Murray. I mean, Professor Murray, you've led this incredible life of advising on innovation on all fronts, right? From like government, private, academia, obviously, and actually bringing philanthropies together. And so, I mean, you have a lot to add to this, so I welcome anything you'd like to add, but this question I would spark is, what is the competitive advantage of philanthropic capital in this whole discussion of deep tech innovation?
Sure. So first, thank you, and thank you for having me. I really appreciate it. And for people listening who are at the first panel, you've obviously heard a tremendous amount about Prime, I'm sure, from Matthew Norton, who does a very fine job and has been incredibly important in that journey. So if I repeat anything he says less articulately, then I apologize for that. I think that the core opportunity for philanthropic capital, I mean, one is just its sheer scale. I mean, when you actually think about how much money in the economy is tied up in, you know, very, very large philanthropic organizations, in endowments, in family offices, right? I mean, we are talking about an enormous pool of capital. And to the extent that even small fractions, and to come back to what Leon said about, you know, the asset allocation, if you even think about allocating small fractions of that to deep tech, and deep tech in service of very particular long-term impact-oriented goals, then I think that there's the potential for transformative change. So I would say the first thing that philanthropy can do is just at a sheer scale. Right? I think the second thing that we have the opportunity to think about is how we can use that to sort of shift asset allocation. And so if we think about the fact that there are these early stage companies that are often incredibly important sort of carriers and drivers of innovation in today's economy, that many good ideas kind of come out of labs and end up in the economy solving big problems through a startup vehicle. Venture capital, I think, is traditionally optimized for software. Deep tech obviously has many different challenges. If philanthropic capital can even sort of, to a small extent, shift asset allocation towards that category because of their impact orientation of those companies, then I think that's a second piece. And then I think the third piece is this catalytic point. So we think a lot about the role of philanthropic capital as being catalytic capital. So not just valuable in its own right as an amount of money, but actually it's crowding in potential. So if I can deploy that capital well, then can I crowd in more traditional market rate capital? Can I crowd in capital that might not otherwise be there? Can I take early stage risk out of a project and therefore really shift how other people are allocating their money? And so I would see those as the sort of three things that philanthropic capital can do. And then perhaps, you know, I'm very happy at some point to come back to this question of whether or not, as currently configured, in our experience, what has made it hard for philanthropic organizations to perhaps do this, or why it is that this is quite a significant journey and that these conversations continue to be really important, because it's actually asking a lot, in my view, of the philanthropic sector to do this work. It's not easy work.
Great. We are actually going to come right back to that. I think that is an important question. And Janu, there was, I want to pick up from what Professor Murray said about catalyzing, because, one of the questions we got when we were putting this on was, hey, is this all about big money, right? And if I'm a small foundation, what's my role here? But I think you have a really interesting story to tell about how do you work with the ecosystem? How can you bring philanthropies into creating an ecosystem like a functioning carbon market that basically gets people investing more deeply in deep tech, because once you have a carbon price, it makes a lot of sense. I was wondering if you could just take us through a little bit of that journey and what the role philanthropy played in creating that ecosystem.
Sure. I think if you look at my my journey for the past 20 years, I did nothing but one thing, that helped China launch the largest carbon market in the world on July the 16th. And then I am shifting to this BRI Institute, trying to pick up on new stuff. But I have been running this EDF China program for the past 22 years, and I've always been on the receiving end. We always need to raise funding, big and small, and to support the mission that I'm personally committed to and the organization is committed to. So I think really what's important is you need to have a vision. I think I'm certainly working for this EDF China program is a really sort of typical NGO, and my experience is that really need to have a vision and a strong commitment, conviction, from the very beginning, for you to be able to raise money, big and small. I'm not going to sort of name them, but this whole thing was started from a family foundation. A very wealthy person works in the insurance business that has some passion for China, and he just gave some small amount of money. Say you guys go out and figure out what you think is the most important part for China to get on this journey. So we were able to convince him that we think to help China to use the force of market, namely put the price on carbon, is the most important thing to do. And that's how we got started, 22 years ago. And just keep going on. There's over this sort of up and downs of climate negotiation. You may or may not remember Copenhagen, Paris Agreement, the most recent Glasgow meeting. And then along this journey, while you'll be able to work with small money, to pick up the momentum, and then some guys came in. We had a very large gift from a very newly startup foundation, a huge one, actually very committed to carbon market, and they have been supporting us for the past 10 years, and that really become the backbone support for where we are today. So I'll come back more sort of into the landscape of the issue that I'm more thinking about, but I think it's really important for you to have a vision, and not just a short-term one, but a longer one, and be able to lay out your case. And I think that's, from a receiving end, that's really my experience on, how to be able to do that.
But what an incredible example to see that, philanthropy seeded something that turned into the world's largest carbon market, right? I mean, to Professor Murray's idea of catalyzing, that sounds like a great point of leverage. But I did want to circle back to this question of small, and Janu, you brought up the COPs, right? And I was there at the last one. It was quite cold, I should say. And you go to COP26, and if you look deeply at what people announced, what they announced was, we'll do X, and then we're expecting technology to do Y. And we don't quite know what that technology is, but we think it's out there. Like, that's really, if you look at the commitments, that's really what they are. They're a prayer on technology at a certain point. And so I want to come back to this question of, do we need to shift to a war footing with respect to the kind of capital that needs to be deployed? Because it needs to align with what is a very ambitious goal that seems to be completely reliant on some breakthrough technologies in the future if we're to meet our climate goals. And so, back to both you, Leong, and what Professor Murray was talking about, what needs to be done to not just make a small shift, but make a serious capital allocation to the kind of risks we should be taking? So perhaps starting with you, Neil.
Sure. This is a tough question. I think to me, as an investor before myself, I would say for any philanthropic foundations to be able to do that, to take on the kind of risk and the more sort of unknown technology risk, I think first thing we need to do is probably just build up our own team and our own knowledge, because I think we said, share in the preparation session, if philanthropists are expected only to fund the valley of death, then it looks like you're only funding potentially just the losers, right? That would not be an appealing proposition to any philanthropist. So I think you can only invest based on knowledge and understanding. So to me, the first thing that we need to do is to really build up that knowledge and understanding, so that we know you are betting on something, but there is a whatever likelihood or chance that they may come out. So I think that's one. Now, the second thing, I actually feel like, philanthropist doesn't have to be just the investor. I think sometimes we can be the consumer as well. So for certain products, when they go through a testing period, certainly I think, philanthropists can go in. For example, in Hong Kong, we funded a lot of NGO buildings, university hostels. So we actually funded a lot of these infrastructure capitals in the number of years. But in the last 7 years, one thing we did very differently from what we used to do before was on every single one of these infrastructure building we funded, we asked them to be a green building. So either they deployed the LEED standard or the Hong Kong local BEAM standard. So in that sense, we become, a major buyer in the city for, architectural firms and construction firms to build buildings that would emit less carbon. I think in that sense, we may not be directly funding deep tech, but for deep tech companies or deep tech entrepreneurs that they know, somewhere down the road, potentially some philanthropists can also be the customers buying things as well. So I think that could be the other angle of looking at it.
Yeah, and I think, Jianyu, I'm going to come to you on that one as well, given your new role around how a lot of infrastructure roles could actually be creating investments, could be creating markets. But first, I want to just turn to Professor Murray about this as well, right? Like, how do we get much more, right? This feels like a war footing.
I think it does. And I mean, the question I would ask, which is often a question that people, when we say, technology will solve our problems, I think there are probably two important categories to think about. And one is there are things that we already have invented that we need to deploy at scale. And our problem is in this question deployment. And that at least the technical risk has been taken out of it, but there's an enormous amount of market and deployment risk. When that's the case, there's both an investor question, because we're trying to invest in companies who are trying to do that scale deployment. But I think more importantly, there is this customer question. And so I think creating the demand and doing that in some really interesting ways is a very powerful opportunity. And I must admit, I thought a lot about the role of government in doing that. So government as a key customer, government and its role in procurement. There's lots of very important examples in that for companies, particularly startups in sort of deep tech. I think Neil's point and Jianyu, that philanthropists can do that, whether it is through the way in which they sort of think about infrastructure, their commitment to that, philanthropist as customer, or as at least provoking demand of very particular kinds, is a really important idea. So that is where I would sort of focus the attention when it's technology that we know exists, but we just really have problems with deployment. I then go to the other end and say, what about the set of things that we know need to be invented, where there's sort of first scientific and then kind of technical risk to be removed from the system? And I still think that there are things like that. And I've often pushed the Prime Coalition team to think about where those gaps are. So at any given moment in time, what's the state of our knowledge? And so sort of where do we see underinvestment? When we see those gaps, I think there are opportunities for funding that work in universities and research institutes, if we really think it's still reasonably fundamental. And then again, I think I would look to the sort of capital gap for startups. And so I do think that we have at least 3 mechanisms by which we can start to, get onto that wall footing, as I think you kind of wisely put it. One is sort of still in the early lab phase in universities and research institutes. The second is in startups, but the third is absolutely as customers sort of provoking to procurement demand at scale. Because frankly, at the end of the day, if we deploy one of something, that really isn't going to make enough difference. We have to deploy it at scale quickly. So I think your question, I think, forces us to think about that continuum and where the big gaps are, and those gaps kind of move over time in some quite interesting ways.
You did mention that one of the things you look at in Prime Coalition is also like what's underfunded. So I just do want to just follow up. What do you think is the most underfunded?
So until very recently, I would have said that everything to do with our food and agricultural supply infrastructure was massively underfunded. And so I became, the group around me know, as do my students, that every now and then I become really obsessed by certain bits of technology. And then every example in my classroom becomes about that. And so for the last 18 months, I've been quite irritated about food security. And I think COVID has shown us how, global supply chains are very complex, and then food, and agriculture, that's an extremely important issue. If you then look at the carbon footprint in those areas, it's huge. And yet the traditional sources of technology, i.e. universities, very few universities today really have major commitments to sort of food and agriculture. It was something that many universities used to have. In the US, I can think of the University of Wisconsin, like massive dairy expertise, and then California, wine growing and so on. I think it became very unfashionable. And so lots of universities closed down that expertise. And so now it becomes a question of how do you reinvigorate that for the 21st century? So I'd say that's one area where I still think that there's probably underinvestment in some of the fundamental science, as well as in some of the companies. And again, I think in industrial processes, we are again seeing much more of that in terms of low carbon footprint, low CO2 emitting concrete and steel, things that go into infrastructure. And yet at the end of the day, I think there's a tiny fraction of that activity happening relative to what needs to happen. And we're not building the foundations in literally and figuratively in our universities. I mean, civil engineering is less fashionable. Are we creating the human talent and the interest and excitement, as well as some of the fundamental knowledge? I think there's still much to be done in that sort of infrastructure, physical materials, the production of the core materials of our economies.
Fantastic. And Jianyu, I want to connect something that you were saying and Professor Murray was saying about this idea of buyers, right? Like, firstly, with carbon markets, you effectively change supply and demand altogether. And I'm wondering with BRI, what is that opportunity to say, well, when governments are making these enormous infrastructure investments, how do they become sources of innovation by trying to buy the most cutting edge, right? Is that something that is possible, and is that a role that philanthropy and your institute can help play?
Yeah. Well, I want to put something that I wanted to say earlier is really in what you believe, right? And I think if you believe, again, everything we're talking about right now is looks through this lens of the climate change. I mean, you can say I'm biased, but I do believe it's a crisis. So if you believe it's an existential crisis, and you believe all the numbers the scientists have been putting forward, that even with 90% of the countries committed to carbon zero, we're still about 50 billion tons short in terms of the gap from what we're emitting right now to what is needed to carbon neutrality. And you also know, IEA has put forward this sort of this theory that 90% of technology that's needed are still either in the lab or not even in the pilot yet. So the window, the pathway that can help us to get to our goal is really narrow. So then that leads to the question of where you make the investment. I mean, clearly, I think for something like climate change, it has a very strong both temporal and spatial sort of dimensions. Then everybody needs to really make a judgment call in terms of where you want to make the investment. So coming back to your question on the BRI, I believe in those developing countries, that's why actually we see I won't say flooding, but really a big, coming of the philanthropical money trying to support something on the BRI related issues, because they see a great premium in terms of making investment in the BRI countries, because they're still at very primitive levels of development. And in other places like China, more developed world, the cost of because they have been doing this for the past 10 years, the cost of solar and wind has decreased dramatically. So that's really, you see the deployment that you get the best return in terms of that's where you do. So that's the sort of spatial dimension. On the temporal dimension, I think right now there's really, as I said, the IEA has told us there's really no really clear pathway with regard to how we'll be able to get to that. And we know every country is trying to make some effort, but the question really is where to push the button. And whether right now we should put our effort more in the sort of application of those technologies already, or we put money into more sort of the virgin sort of kind of ideas, like what you mentioned at the very beginning, sequester carbon into rocks or something of that sort. So I really think that first you need to have the conviction, you need to believe what you're investing, and then you need to do a very, very systematic sort of analysis in terms of the characteristic of the climate issues, so you can decide on where you put your money to.
Fantastic. And by the way, I think your bias is a good bias and one that we all share, right? Let's bring this down to a city level, just because I mean we're having a macro discussion, but I think it's kind of interesting. When Hong Kong is something we feel like we can put our arms around. So as someone who works deeply in Hong Kong, right? For Hong Kong, what would be priority opportunities? Where's the big innovation space that you see that you would love to think about investing in? And I'm sure people are listening very keenly on this one.
Sure. Now, I think Hong Kong, as we all know, it's a metropolitan city. It's 7+ million people crammed in a very small space. So naturally, we have a lot of buildings. And naturally, the building emission is actually one of the largest causes of CO2 emission. So I think it's about 64% of the total. So a lot more than transport and other things. So to us, this is also an area we have already invested in quite substantially. In fact, very interestingly, if I may share a quick story, 7 years ago when I joined the Jockey Club, one of the first things we did was we look at the past buildings that we helped funded, that we donated. We very seldom attach any kind of green building criteria to it. So we thought, oh, that would be a quick win, without even thinking through other things. Then whatever building we're going to support going forward, can we just turn them all into green buildings? So I think that's one of the things we started doing. And along the last 7 years or so, we have also then went into about 120 schools in Hong Kong, because they all have similar patterns, similar behavior, similar usage. So we done audits for these schools, and we also retrofitted, all these schools, and ended up having sort of around 15% carbon reduction from each of those schools. So I think to us, if we can solve the building emission puzzle, so maybe starting up with the education sector, with the NGO sector, but then gradually then move out to commercial and residential, it might really move the needle in that sense in a metropolitan area. And this is also something I think for other cities, also very sort of very high reference value if we were able to do that. So this is something we're working on now.
And I think maybe a good example of the different types of things that Professor Murray spoke about, like the first 20% of that reduction, you can kind of get from deploying at scale existing things. But trying to get from that 20 to 80% reduction requires a step change in science that isn't quite there yet, right? We haven't done it with air conditioning and so forth. So
absolutely.
That's a really good example. Professor Murray, I want to use the opportunity for the fact that the people we've invited to this closed door session is actually senior philanthropy leaders, right? So that's the audience. And I suspect you spent a lot of time trying to convince philanthropic organizations to make right-sized investments in deep research, both in your academic roles and your Prime Coalition role. So what do you think is a change that philanthropies need to make to better engage with the innovation ecosystem? Right? Like what is it? What are you seeing as the cultural blockages or systemic blockages that they have? And you're speaking to all of them, so you don't have to single anyone out. So feel free to speak freely.
So I will speak to everybody. So I think, and all of you in this field will forgive me if I'm mischaracterizing your organizations, but in general, it's often the case that philanthropic organizations, family offices, regardless of their size and scale, have typically organized themselves around sort of two buckets. And so you have the sort of the group of people in the organization who are thinking about kind of giving out the money, who have the impact and the charitable mission kind of front of mind. And then you have the group of people who are focused on investing the kind of the corpus of the endowment, right? Whether or not that, and the kind of money to create the returns to then enable all that impact oriented activity. And I would say, and this may be particularly true in the US, and this is the place where I have most experience in this, that those two groups of people are often quite different. They're quite different in their backgrounds and training. They're quite different in their sort of sensibilities in what it is they prioritize. And organizationally, frankly, we reward them very, very differently. So we reward grant makers for kind of efficiently getting money out the door and for sort of meeting certain kind of impact goals. And we reward the people who are managing the money for sort of maximizing returns. And so it feels as if we basically have two separate cultures. And that's how these organizations have grown up. As soon as I think we start to think about understanding having this sort of climate impact in this much more integrated way, starting with investing in some of this deep technology, really accelerating and catalyzing startups, thinking about being the customer in whatever order that may be relevant given our challenge. We're starting to talk about using mechanisms for doing so and for deploying capital that are much more than just traditional grant making, just giving people money. And so we're asking for more sophistication in financial instruments, in recoverable grants and program-related investments, in warrants and so on and so forth. And I think that financial expertise typically doesn't live in the grant-making side of the house, but nor does the impact measurement live on the investing side of the house. And so what you're asking people to do is effectively create teams that don't traditionally talk to each other, who are willing to have crosstalk, and who are willing to use the instruments of capital markets in new impact-oriented ways. And so for me, it has often been challenging to have those discussions because we're asking people to both come together and talk to us, and we're also asking people to sort of adopt new ways of working. And I think in any sector of the economy, that's always quite challenging. So that's what I hope that philanthropists would be willing to do, is to engage in those discussions. On the other hand, I will tell you that if I'm sitting in a university, I think I have to also get out of my own comfort zone. If I say it's important for me to have, funding for certain kinds of research, I need to be willing to articulate, not just give me the money and don't worry, I'll look after it well for you and do great research. I need to have a commitment to telling my philanthropic partners what the potential paths are from which those ideas get out of the lab. They don't just get stuck. Likewise, if I'm a startup, I have to be willing to talk to philanthropic investors in ways that don't just say, give me the money, you take an equity investment, it'll all be fine, but actually to commit to how I'm going to maintain their impact-oriented vision. So I think both sides have to talk differently and have to learn to understand one another more profoundly, and be willing to have these more integrated conversations. And that's what I hope when we come to the table. And at Prime, we've done that by doing this sort of almost like one deal at a time to start to educate ourselves and our philanthropic partners before we start to scale some of our financial instruments, just to do that learning together.
Yeah, my takeaway from what you're saying is you'd like to see philanthropies be more flexible effectively, right? Like you're looking for more flexibility in their processes, more flexibility in how they give, but then how can not just the philanthropies, but you guys also get together, right? Break down the silos a bit. So it's a super interesting example with Prime Coalition. And John, same question to you, because I know you've basically been engaging with so many philanthropies to get, big stuff off the ground like the carbon markets. What's your advice to them? Right? What do they get? What do they get wrong? And just to make it more interesting, right? What do philanthropies get wrong?
Well, let me make an observation, and then also to talk about. I don't know whether I can say that they're right or wrong, but let me start with the observation. I think the philanthropies are really they're more, at least from the lenses from those that I interact with, they're becoming more action funds rather than investment funds. I mean, I think there's also a reason, probably because there's so many new founders in this field. They're young, they're very passionate about certain issues like climate change. They really want to change the world. And in order to achieve that, they really want to take issues into themselves. So, they make strategies, they hire professionals, and the most popular word these days you hear is this whole idea of a co-creation. They want to co-create a strategy with you. So not just sort of, they're not just the buyers or the customer. They want to be the doers, and some people even call themselves the do tech, rather than just the give out the money. And in some sense, the NGOs I think also become a little bit more towards their end. I mean, the NGOs trying to also want to be regranters. They also, you want to, because you're on the field, you know the people, the workforce who can do that. So you want to be able to have some control of the money yourself, so that you can also co-create things. Again, I actually do not know whether this is right or wrong. I mean, even I have a sort of 20 year tenure for this, but I think I'm still very young in this field. I don't know whether this is sort of a circular thing that just keeps coming back, in a decade or something, or it is really because of the characteristic of the new money going into this field, and also because of the sense of the urgency that we're seeing right now. But my advice, to the NGOs and the startups really want to get this money, I think co-create, because that's probably a really important sort of tools that you can use to persuade the founders to grant the money to you.
This co-creation idea, super interesting, right? And not enough of that, but certainly we are seeing very activist money, right? And I think your point of people wanting to not just grant, but to do, and that's whether it goes from audacious to some of the other kind of philanthropic coalitions that are coming together. There's a question from the audience that I wanted to pick up on now, because I think Professor Murray brought this up as well, that there is an enormous amount of money that is sitting in philanthropy. We often focus on the big grantors, including the Hong Kong Jockey Club. But if you actually just look across even family offices, just actually once you aggregate that up, it's enormous. And there's a question from the audience that's asking, well, okay, they're not making these investments. So any ideas on how to approach family foundations, how to change their perspectives around focusing more on these kind of longer term investments? And Professor Murray, maybe starting with you.
I mean, I think I would go back to Jan Yu's point, which is, as we see these family offices, there's often a generational shift, right? So when you see a shift in generation, younger generation, probably just a different willingness and interest in trying to do things in new ways, right? Taking on what I think is, the issue of our generation and the next and the next, but being willing to do it in different ways. So I think focusing on the right kinds of family offices, thinking about that moment where you see, generational change, let's work with this new generation. Also working with individuals who have often today, and this is one of the things we observe at MIT a lot, is that many more people are making tremendous wealth quite young through entrepreneurship. And that has two implications, right? One is people's concern over climate change is often, inversely correlated with age, although not entirely. So that tells us something about people's interest. And I think if people who've been entrepreneurs, they very much appreciate market mechanisms, and so are willing to think about doing things in a slightly different way. And so identifying those individuals, And then the path that I think is really powerful is to say, this is not about sort of massive reallocation of your assets. You can do this in a step-by-step basis. It would be useful if we learn quickly, because it's not enough to do just sort of one deal. But I think bringing people forward, I mean, again, curating investment opportunities, research opportunities, probably deployment and demonstration opportunities that have been discussed, I think is a really useful way to start to gather momentum. My experience is once a few people have done it and it starts to make sense and we have some coherent language and existence proof of these mechanisms, that you really do start to get a community of people for whom this is a very different approach, but it's an incredibly appealing and powerful approach. So I think that's what causes this cascade of funding and different behaviors to really happen in the offices. And so we've always tried to identify family offices where we see generational change, or where we see much younger philanthropists wanting to make change. That's been a very useful thing for us in the work at Prime.
Yeah, I think very sage advice to say, look for that point of generational change. And Leo, I wonder if you want to also come in with your sort of previous private equity hat as well. Like, how would you think about bringing in these family offices more closely into this space?
I probably don't have a lot to add to Professor Mori's comments. I think she hits on the right points. And also, every family is quite different. They all have different interests, different risk appetite, different engagement process and style. So it's quite hard, I think, for me to comment in general. But I agree. I think given the change in generations, the topics on climate change, I think it's becoming more and more digestible to the current sort of family office, whether they're the management team or the owners themselves. I think maybe one thing is quite critical for a topic like this. What you need is a long-term commitment. So it's not a one-time kind of grant. So I guess my advice would be, when you talk to these families, try to also understand and hopefully can engage them on the issue for longer time, rather than just say one grant kind of approach.
And John, one question I had for you around the same thing is, as you think about bringing philanthropies into these sort of long-term engagements that you've had, and for example, building carbon markets, what are some of the techniques you've used to sort of crowd in people? Like, what are some of the advice you have of bringing, because you built a whole coalition of philanthropies to engage in your work, and I think it'd be really interesting for us to see how did you crowd in so many different organizations?
Yeah, I think it's really interactive. One thing I want to point to, in the field of climate, there's a growing trend of cooperation, coordination among the founders, on issues. There's actually in existence a mechanism called the founders table that they meet regularly, and they will talk with each other, and analyze the pros and cons of certain policies and certain organizations, and really trying to sort of do that in a more efficient way. And I think I mentioned the word co-creation. I think it's important, and you use every opportunity you have, even use the opportunity like when you're being audited, try to talk with them and use that process as a very unique opportunity to really analyze things to death, to demonstrate to them why you're doing certain things, and why you think that needs to take longer time to get it achieved. And also, I think Professor Mori's point of this generational change is really important, because once you have a mechanism like the founders table, not only sort of the existing founders trying to be more active, but what we actually seeing is it becomes such an important magnet that attracts other founders, even family offices, big and small, to join them, because they think there is a good mechanism there for them to really get exposed to what is the mainstream idea, what's the cutting edge sort of investment opportunity that we need to make on, so on and so forth. So so it's really, I think this sort of the gap of information is actually diminishing. I think from a doer sort of point of view, I see the whole thing is, I think it's getting more transparent, and you just really need to, again, going back to my earliest point, you really need to have that conviction and just do the things that you're good at. And I do not think in the field of climate change right now, money is the biggest constraint. The constraint is really the issue itself.
I think that's actually a great one to close on. I've got the organizers telling me I must bring this to a close, but I thought that was a nice note to end on. I think what the panelists have really done is recognize, firstly, that philanthropy does have an important role to play in realizing all that potential the first panel brought up. But there is a change that is needed within how philanthropies are functioning and engaging, if they're to engage at the level that's required, right? What the actual ecosystem is asking of them. More flexibility, more partnerships. And I think it was really interesting to also recognize that it's not just about direct investment, but many ways in which you can support the ecosystem for deep tech as well. So there's a role for big and small philanthropies in this game. I want to just again thank Leong, Fiona, and Jian Yu for their time. That was really excellent. Thanks so much for your insights. But otherwise, thank you everybody for joining us today.